One of the best things to know as a new investor is where not to invest your money. Now, why is that the case? Well, it's because the math is not in your favor. As you know by now, when you lose money in the stock market, it is going to cost you even more just to break even. And there are sectors in the stock market that are likely a no-go for the rest of this year and could go into 2024. So let's go ahead and break it down. The first one is finance. The finance sector has not done well this year. If I had to guess as to why, I'm assuming it's because of the banking crisis, which actually happened earlier this year. It feels like it was a year ago, but no. Rewind the clock, it wasn't that long ago. We have videos about SBV and Signature Bank and all of that turmoil earlier this year. But companies like Charles Schwab, down 29%. Truist Bank, down 29%. Bank of America, down 13%. PNC Bank, down 25%. I really don't have any other reason as to why this entire sector isn't doing well, with the exception of a few. Berkshire Hathaway, they're usually classified in the finance sector. They're doing fine, but the majority of them, not so much. So for me, I would avoid finance. If you want to add something to your watch list for later on when things improve, feel free to go ahead and do that. But if you lose 30%, it's going to be hard, right? You have to make anywhere between, 40 to 60% or so just to break even. I'm just doing that math off the top of my head, so feel free to double check that. But it's not easy. It's not easy to come back after a 30-point loss. Not impossible, but very, very difficult. So watch out for those. The next one is a little bit of a mixed bag, and that is health technology. Now, companies that fall into this sector could include a Johnson & Johnson, which is down 7%. Pfizer down 29%. Even a company like AbbVie, which we have talked about a year and a half ago, they're down about 9%. Now, the good thing here is there are a few deals to be had, and there are some stocks in this category that are doing incredibly well, like Eli Lilly. We've talked about them before. They were up, at least the time we did that video, like 60 or 70%. So it's not all bad here, but the ones that are bad are really weighing down that entire category. The thing that's interesting here is that this is one of the few times that a sector ETF, that means an ETF, a fund that holds multiple stocks in one category, can be detrimental, because you can own Eli Lilly and be up 60, 70, sometimes close to 80% on a stock like that, but then you've got Bristol Myers Squibb weighing you down, you have Pfizer weighing you down, you got Moderna weighing you down, which is down close to 40%, and then you're kind of hurt by investing in that category as a whole. So would not invest in a sector fund for health technology right now, and I wouldn't invest in any of those stocks that I just mentioned. But Eli Lilly, stock we've covered, that one might be a good place to start. Next here is consumer non-durables. That's the category that they have on here. Basically, it's the staples, the stuff that we need usually. Now, in a normal year, these are safe stocks to be in. A normal year, they pay solid dividends, but that's not what's happening so far in 2023. And we've talked about the reason as to why. People have left what was known to be defensive, that pay great dividends, that we knew people were going to use in any economy, in any market. They've left all that behind. They've all gone to tech. That's really what's happening here. Coca-Cola, for example, down close to 5%. Hershey, we talked so much about Hershey. It was an excellent stock, but in 2023, it's down 6%. Now, honestly, it could be worse. It could be way worse, but it's down, okay? A company like Smucker's is down. General Mills, that we talked about, which was an excellent defensive stock last year, down double digits, close to 18%. Estee Lauder, we've talked about in the past, and that was almost 2 years ago now, but they're down 40%. And then we even talked about Nike. Nike could be on the fringe side of this category. They're down close to 15%. There's not a whole lot to like in this category right now. Do I still think that Hershey or Smucker's or even General Mills, do I think those are solid companies? I still do. They make money. They're fine. They haven't really seen a slump in sales, especially for Hershey. They reported a greater than reported. They had a better profit than what they expected. That's an easy way to say that. And stock still fell. So I'm kind of hands up in the air on that one. I still own Hershey. I would like to continue to own them, even though they've kind of fallen off so far this year, because it is a good stock and it is a good company. But the market does not feel that way. But if I'm looking to invest right now, because I invested a few months ago on that one, that's not the first place I would look, okay? Next here is utilities. I've talked about utilities before, again, for the exact same reason as consumer staples. This is where people go for safety. This is where people go for dividends. It's not where people go when the market is up the way it is. I mean, AEP, which was an amazing stock right around the pandemic era, down 16%. You've got, I think it's Dominion Energy. I'm looking at the logo here, down close to 20. NEE, the stock symbol here, that one's down 19%. it's very difficult to find great stocks in the utility sector. I did find one. If you want to know what that one is, you want to check out our best dividend stock in every sector video, because we did find one that was doing incredibly well. So I'll save that one for you in that video. The next one is health services. This one, I'm annoyed by it, but the market is what it is. So when we say health services, this is primarily health insurance companies. So UNH, one of the largest companies in the US. If you look at any US stock market index fund, you're going to find United Healthcare somewhere in that 6 to 7 spot. They're down 7%. Anthem is down. Humana, which was a great insurance company that did well last year, not doing so great this year. Cigna down 14%. It was an amazing stock last year and almost a year before as well. Not doing well. All of those are down for the exact same reason that utilities are down, the exact same reason as to why consumer staples are down too. The next one here is retail trade. Now this one is interesting because last I checked, which is like every week or so, consumer spending has been fine. Yes, inflation is up. Nobody likes inflation, even though inflation has been falling. Because a lot of these consumer stocks haven't done well. So Target, we've talked about how bad Target has been. They're down only 18% because it was worse last year. CVS down 27%. You got Dollar General and Dollar Tree both down, and then you can throw Ulta down there as well. Even though Ulta's financials look fine, the stock does not. Now the good thing here is there are some stocks that are doing well. Walmart being one of those, Costco being one of those. We talked about how Costco has been one of my favorite stocks for several years. Those are the few that are doing well in the retail trade sector. I don't have a great reason as to why these stocks are down outside of Target, because we know they have some mismanagement stuff. We know there's been some weird political stuff going on with Target. But why CVS? What did CVS do? What did Dollar Tree do? What did Dollar General do? They used to be one of the best places to fight inflation for investors, and that just has not been the case here. And I don't have the greatest reason as to why in that space. The next is communications. Now we have talked a little bit about communications, and I'm gonna give you a hint here as well. Verizon, T-Mobile, AT&T. All bad right now. Hopefully things will change. I used to love T-Mobile, but y'all saw I got my money out of T-Mobile. We made money and we left. Okay, so sometimes it pays to be a subscriber when we talk about these things. But Verizon stock we have never liked is down 15%, as well as AT&T down double digits as well. There is a silver lining though. Comcast is doing well in this space, up more than 20%, and it pays a solid dividend too. So there's one company that I can find in the communication space that is doing well. If you want to throw Netflix in there, you can. If you want to throw Disney in there, that one's down 5%. So you can kind of balance that one out how you will. But here's the next thing. Okay, now you know where to avoid, but if you're looking to build a diverse portfolio, you have to have stocks in every one of these categories. But what are the best stocks that are doing well in each of these categories, and what stocks are they? Well, if you're looking for that answer, I have it right here.